In the next couple of videos, we're going to talk about financial securities and the marketplaces where we can issue and purchase as investments these types of securities. So let's talk about some basic concepts of securities themselves. Financial executives are a little bit more than just somebody that runs the finances, right? Part of the program, part of the process is you have to understand how to get the money that you need. So we have to sell something. And selling is the wrong word, but we do have to issue securities to the public. So we need to figure out what products, in quotes, what products the public wants. And then we have to provide those products. So we have to act as a marketing person in certain respects. As far as the financial institutions themselves and the instruments, right? I mean, there are not a lot of major constraints. Now, we do have to register securities, right? This has to go through the SEC. So when we apply to this, that's what's essentially what is registration. The SEC takes the documents that we provide. Now, one of the things that happens, though, is the SEC doesn't say this is a good thing or a bad thing. Their check is to make sure we have adequately disclosed all the information that's supposed to be disclosed. If we've done that, then they will then authorize us then to take the next step, which is to publish the securities. So markets themselves are people, or are people and generally run markets, right? If you think about a vegetable market downtown, right? I mean, there are people that provide products, there are people that buy products. Well, the people who are selling things obviously have more than what they need, and they're trying to get money for that. And that essentially is what's happening with financial markets, right? People in general, and this is kind of hard to imagine since we typically think of individually, but in general, people have more money than they need as a whole. Governments and businesses need money. They have a need for funds because they don't make enough profits. They don't gather enough taxes to pay for the things that they want to pay. And in the case of the government, it's not really that they don't have enough taxes to pay. The challenge is taxes are only paid certain times periodically, but business runs 24/7. So in order to pay for the year's expenses, we need to borrow today to make those payments. Now, there's a couple of ways we can talk about financial markets, and we can talk about what's referred to as a money market. In general, money markets are instruments that by definition have less than 1 year of life. The capital markets then is everything else. So money market instruments are really short-term debt securities, while the long-term securities are typically what we refer to as bonds and stocks, which is primarily what we're going to talk about in the next several videos. There are three variables, if you will, that financial executives think about when they're thinking about issuing securities, right? They want to know what is the investor's claim on the business when this is over. For instance, if you issue debt, then the investor's claim is on future cash flows if you don't make the payment. If you issue securities, you do have a claim on cash flows. However, it's not a contract if it's a stock. Do investors have a right to participate? Bonds or debt, they do not have a right to participate. Stocks, they do. What about the investors' claims on the assets? Well, in general, creditors are in the front of the line, if you will, when they're handing out money if the company goes bankrupt and begins to liquidate. The shareholders, stockholders, are at the back of the line. They only get something if there is something left over. So there are three basic types of securities that we can discuss in the business context, right? There's debt, which are obviously that is lending money, right? Or borrowing money. And there are fixed claims associated with that. There is equity, which is the issuance or purchasing, if you're buying it, of ownership in the company. But that ownership is a residual claim. So debt has less risk since it's fixed and it's certain than equity, which is not fixed and is not certain. Now, there is something referred to as a derivative security. Now, derivatives are a little different. For the most part, they are used for what we refer to as hedging activities from a business context. That companies will buy and sell these derivatives in order to hedge risk, try to reduce risk, increase the certainty of cash flows. So we have what we refer to as options. These are typically based on stocks, some currency, etc., and they give the investors rights to do certain things. But from a business perspective, the most important type of a derivative is something that might be referred to as a future. And futures when you deal with commodities. So commodities, if you are a baker, right, if that's your company, you obviously have an interest in buying flour and wheat, right? Because wheat makes flour. So you are interested in the cost of wheat because if the cost of wheat goes up, then your cost of goods sold goes up and you want to try to control that. We'll talk about this a little bit in some later videos, not in a lot of detail, but because it is a little bit beyond these introductory kinds of contents. And there are some hybrids. They mentioned here convertible debt, which really combines some of the characteristics of both debt and equity. So let's first start talking about bonds. They are what are referred to as fixed income securities. They promise to pay interest for a certain period of time, and then they pay back the principal at maturity. So this is different than your car loan, right? So if you buy a bond, you're going to get interest payments every year until the bond matures. When it matures, they will pay you the principal. Now, 99% of all the bonds that are sold in $1,000 increments, right? So typically the principal is $1,000. In recent years, they say roughly about 69% of business comes from internal things, profits and depreciation. 44% of all the external stuff then, right? That means us 44% of the 31% that's not internal is bonds. So bonds are a very important aspect of external financing. Again, it's not almost 50-50, but not quite. Another 10% of this external financing could come from loans. So if you kind of put those two together, right, 54% of external financing comes from debt types of instruments. That must mean that 46%, again, they're almost even, comes from the issuance of common stock. We've talked already, the par value is roughly $1,000. The company, each debt instrument, because it's a loan, has an interest. We refer to this interest as a coupon. And the reason we do that is because historically, if you were to go back 70, 80, 90 years, when you bought a bond, it actually had a perforated margin, if you will. And each one of those perforations was kind of like a little stamp. And you would tear that stamp off, the coupon, and you would provide that stamp or the coupon to get paid. So that's where we get this coupon rate. The maturity date, just like any loan, if you get a 7-year car loan, 7 years from now, that's the maturity date. Most debt is a little bit longer than that. Most corporations and a lot of the government debt that's issued is in the 30-year range. There is debt that's issued that's less than that, and there is debt out there that has far greater than 30 years. There's something called a sinking fund, and this is just a requirement for some companies that may be a little bit less financially stable. They still are going to get a bond, but the bond holders are going to require them to periodically buy back some of the debt. So this is kind of to get them to keep up so that at the end, if you think about it, if you borrow $200 million for 30 years, if you don't have to pay until 30 years, who's going to have $200 million in their checking account to pay off the debt in that 1 year? And the answer is nobody. The other characteristic that is important is the difference between variable rate and fixed rate bonds. Again, 99% of all the bonds that are issued are fixed rate bonds. The coupon does not change. There are some instruments, though, that are variable rate. They are rare, but they do exist. If you think about a bond, here's Walmart. So this is Walmart bond that's a 6.5% coupon. So the coupon reflects the interest payment per year. So 6.5% implies that they're going to pay $65 a year, 6.5% of $1,000. Typically, though, bonds pay interest semi-annually. So every 6 months, you would get a $32.50 check for every bond that you held. This particular bond matures in 2037. It looks like these are $1 million, so there's 3,000. So that must mean $3 billion has been issued. The current price of this, 134.1. We'll talk about this maybe a little bit later, but 134.1, this is really a percentage. So if you want to know what it costs to buy this bond, you take the decimal place and you move it once to the right. So to buy this 6.5% bond, you would have to pay $1,341. To buy this 2.5% bond, you would have to pay $975. Again, this identifies then the coupon, right? And it's telling us here that these are all fixed bond examples. Some bonds have call provisions. It's stated in the bond, so it's not a surprise to investors. But this provides an opportunity if interest rates fall far enough. It provides an opportunity for corporations to refinance their debt. So essentially, they buy back the debt to retire it, but they have to replace that with something. It's like refinancing your house, right? You borrow money today, and you're going to pay that back. You have to pay that to the bank. Well, you have to get another loan to pay off the old house so that you can then have the new house or the new financing, if you will. Now, there is a call price. Typically, it's the par value plus a little bit more. There's usually a delay. Most companies can't issue debt today and then in 2 years refinance and pull it all back. And again, typically investors, this is not good for the investor. I mean, they still might want to invest. It could still be a great investment, but it's a burden, right? It's an inconvenience that somebody may force you to change your investment. So what does that mean? That means that investors want to earn a higher rate of return on a callable bond than on a non-callable bond. And when we talk a little bit about time value, you know that when interest rates go up, when returns go up, the values of assets go down. So callable bonds have higher returns than non-callable, but they also then have, because of that, they have lower prices than non-callable bonds. There are covenants, which are basically the rules. I think everybody understands the rules when you borrow. You know you have to pay interest payments. You know you have to pay back the principal. But there could be some other restrictions placed on you. You may have to, there may be some limits on how much dividends you can pay. There could be limits on not borrowing more money, right? You can't pile more and more debt on top of debt. So again, the idea of these covenants is just to set the ground rules, right? What are you allowed to do? What are you not allowed to do? Now, we talked about this a little bit earlier. What is the order of liquidation, right? Government gets taxes first, right? Senior and the creditors get paid next, and there's 3 levels of them. Senior debt, right? This is debt that might have collateral attached to it, like a mortgage. There's general creditors. This is typically debt that is, and I don't know how to put this, it's the debt that was borrowed first. And then there's what's referred to as subordinated creditors. These are folks further down the line that have lent money later on in the business life. So again, how do you get paid? You're in this order. And of course, you can see here that common shareholders are at the very end. We mentioned these secured creditors. Essentially, they have collateral, right? So if you borrow money to buy a car, the car is collateral. What happens if you don't make car payments? Repo man comes and tows it away. That's what secured debt is. Now, the thing about having collateral is not that it makes the debt less risky to borrow or to actually for you to lend to them, but if there is a problem, it allows them to offset some of the losses that you might incur if the company goes belly up. Again, bonds are not necessarily safe, right? But they're also not as risky as stocks, right? So if you buy a bond, right, here's what you know. You know exactly what the interest is. You know the cash flows. You know when the interest is going to be paid, and you know when it matures. So as long as the company does not go bankrupt, you're going to get your money. So from that perspective, they're fairly safe. On the other hand, the company could go bankrupt. So that makes those cash flows a little risky in certain circumstances. And companies analyze, there are companies that analyze other companies that want to borrow, and they give them what's referred to as a rating. And we'll talk about that here in the next couple of minutes. So if you look here, what's that return? So if you look this, we have the return here. So we have long-term corporate bonds average around 5.7%. Long-term government bonds about 5.2%. So the difference between this 0.5% is what they refer to here as the default premium. Now the real return is the rate minus inflation. So in real terms, if you buy a long-term corporate bonds in real interest, right, you can actually see the growth and spend the growth, you get roughly what, 2.6%. So what's the real rate of return on common stock? Well, 11.4 minus the 3.1 gives us approximately what? That's 8.3%. Now, we can do this approximating. That's what I just did. I'll just subtract. But there is a formula where we can calculate the real rate of return on a more theoretical time value approached model, right? So again, that's how we can look at that. We had mentioned a little bit earlier about bond ratings. There are companies. The three biggest are the Standard & Poor's, Moody's, and Fitch. Essentially, these folks analyze the company. They look at their ratios. They look at debt ratios, some profitability ratios, cash flow ratios, these coverage ratios, and then they provide a grade of sorts. The grade is what we refer to as rating. AAA rated bonds are the safest bonds you can buy. They have an extremely strong capacity to meet obligations. As you go down the list, things become getting riskier and riskier. And as we've talked about in some other videos, if you're going down this list and things are becoming riskier, if you want to purchase them, you want to receive a higher rate of return because of the increased risk. So if everything were equal, AAA rated bonds would have the highest prices. Down at the bottom here, these all have lower prices. Since they have lower prices, again, if everything were equal, lower prices means you're going to get a higher return. So there is a relationship between the prices of bonds and their debt ratings. Let's continue on talking about, finish up talking about bonds. They mentioned investment grade is BBB and above. So those bonds, as an individual, those are bonds that you might like to buy, right? They're investment grade. They're good for people as investments. Below that, though, are what are referred to as junk bonds. Now that's I can't remember what that word is right now. It's colloquial, right? These are essentially speculative or high yield bonds. Why are they speculative? Why do they have so much risk? One of two reasons. One of them could be that they're in trouble. They're just a company that's in financial trouble. But another reason for it being in this category is that they are companies that have a lot of debt, and that debt has made them riskier. So again, junk bonds are frequently used in some mergers and transactions like that because there's so much uncertainty and so much risk going on that they have these lower ratings. So here's a question, right? There's a criticism about these ratings, and this really has come about from the mortgage crisis that I guess hasn't been so recent, but roughly about 12 to 15 years ago, right? That the actual credit ratings of some instruments, mortgage-backed securities in particular, it was very difficult for them to assess what the actual risk was. So then if you can't figure out the risk, then you don't know how much you want to earn, which then also means you don't really know about the price. So there were a couple of mistakes that were made back in those days, and that was primarily they didn't take into account the idea of the housing market and how there could be a decline in the overall demand for houses. So that would then mean what? That there's now less business, there's a lot more supply than demand. Now we don't know anything about buying houses. That was then compounded into the deterioration of some mortgage standards. So again, this is a lot deeper than what we really have time to cover in this class, but this rating system is very important. So if you look at, in general here, what we're talking about, these are bond ratings and the chance of default. So if you're a AAA rated bond, let's just go to 10 years. In the next 10 years, there's about a 0.72% chance that any one AAA rated bond would go bankrupt. They would default. If you go down to the triple C's, in just 1 year, there's a 26% chance. But over 10 years, if you're a triple C rated bond, there's a 50% chance that you're going to go bankrupt. So there is absolutely a relationship between the ratings and the probabilities of bankruptcy. So that's it for the beginning part of talking about financial instruments. I'll see you the next time.